Welcome to The Value Proposition. I'm Lynn Fitzenhagen, Head of Client Development at Barrow Hanley Global Investors. In today's episode, we're going to tackle the increasing dispersion between growth and value in the markets. I'm joined today by my colleague, James Carpenter, who's a client portfolio manager on our global equity strategy. James, thanks for the time. Appreciate you being here. First and foremost, we're in the midst and probably at the tail end of one of the longest bull markets in history. Growth stocks have dominated performance. Why now for value, and what are some of the reasons that you should be thinking about that?
Well, Lynn, it's great to be here with you today. Appreciate the opportunity to talk about value investing and why we're so excited about it at this point in time. As you mentioned, we're at the very end of a very long bull market, especially for growth in outperforming value. And it's a conversation that we're seeing that our clients are asking us a lot, but also those prospects are wondering, hey, am I getting in at the right time? Is there a chance that I might miss a strong value rally? And so I think it's very topical at the time, especially if you look at the following chart. What you'll recognize is that in the first 5 months of this year, so through the end of May, value, the MSCI World Value Index has underperformed the MSCI World Growth Index by more than 20%. If you actually roll that forward through the end of yesterday, it's actually now 24% year to date. So thinking about that in the context of what we've seen historically, these numbers in the last 6 months are far greater than what we even saw in 1998 or 1999. And so we're seeing a very huge disparity between growth and value, and one of the largest dispersions in the last 20 plus years.
So you note the late 90s and some of the similarities to that time period. What other similarities are you seeing today versus then? And what sort of comments do you have on that subject?
Well, it's interesting because obviously your mind is drawn to tech. So if we think about the late 90s and the tech bubble, how it was dominated by a few number of growth stocks or a certain segment of the market in terms of growth. Not too unlike today where we're seeing the likes of Facebook, Apple, Netflix, Microsoft, these big tech companies or internet-related companies having dominated the performance. And importantly, they've become a very, very large part of the indexes, particularly the growth indexes. But if you think about just the S&P 500 index, these five stocks account for more than 20% of the index weight. And that's much higher than it was in 1999 when it represented about 18%. If you were to add to that Netflix, and then you compare that to the economies of France, Germany, Spain, Netherlands, the combination of those market caps are far larger than those countries combined. So we're really seeing an unprecedented spread in terms of the largest growth names out there dominating the indexes. And importantly, another similarity I would want to point to is valuation spreads. So if you look at the following chart, what you'll actually see is on a price to book basis and on a price to earnings basis, what you're seeing is valuation spreads between growth and value stocks, all that are at as much of a discount as they were back into the early 2000s.
Isn't it different this time? Isn't that the common argument, that things have changed and the paradigm has shifted and it won't go back? What gives you confidence in the next decade that it will go back to value's way, in value's favor?
And that's the question I think everybody's asking them is, aren't we on a trend that is going to continue into perpetuity? And if you think about it, that's when we get excited as value investors. It's everybody's extrapolating the past into the future, and you're seeing these large opportunities, and you get really excited. Think about us as being little puppies. We're about wetting ourselves at this point in time. We've got so many great opportunities here. So that's exciting. But if we look back in history, and if you look on the following chart, what you'll actually see is as you look at the top 10 stocks by decade, what you'll see is they're never the top 10 stocks, or rarely are they remaining at the end of that decade as a top 10 stock. So think about this, going back to the 90s or the 80s, it was all things US. But if you would have been all overweight US, you would have missed out on one of the biggest bull runs in Japan. And then at the end of the 90s, if you would have bought Japan, what would have happened? You would have underperformed meaningfully coming into now what is the TMT bubble of the 2000s. Similarly, you buy all the TMT stocks, what happened? It turned to commodity plays and emerging markets. So now here we are again in the early 2000s, and we've got, again, at the top of the chart of this decade, we've got tech and internet-related stocks. Do we think they're actually going to be there at the end of the next decade? I don't think so. I don't think history is going to change. But again, we'll take a look at this chart at 2030 and see if it remains the same.
So James, outside of cheap valuations, what else makes you bullish on value stocks today?
Well, you're right. If you think about just investing on cheap valuations, and that's not what we're entirely about at Barrow Hanley, obviously. We're looking at more than just cheap valuations. But it is something that you can look at in historical terms and saying, okay, what have cheap valuations done as you come off of these long growth cycles and recessionary fears? And what we're talking about in terms of valuation factors, we think about those of book to price, earnings yield, dividend yield. And in fact, if you look at the following slide, we'll use the US as an example, though it's applicable to Europe and even emerging markets. What you'll find after these crises or these crashes, such as 1987, post the tech bubble, or even after the GFC, the factors that you find working the best are value factors. The ones that I mentioned in price, in book to price, in earnings yield, dividend yield, your EV measures, these all work really well coming off the bottom. And what you find not working so well is the growth factors and the momentum factors. And think about the momentum we have in the market right now. So we think using history as our guide will tell us that as we come out of this, we will be able to see a strong value rally. And I will just say anecdotally, if you think about the 2015-16 period where we saw, say, a 6-7 month period of value, these factors worked really well in that period. And somewhat indicative of what I think we're going to see here in the future as we get a lot of this stimulus into the system.
Speaking of stimulus, and speaking of another reason why it might be different this time, we've seen unprecedented action by central banks around the world to pump money into the system. How does that impact the dynamic of growth versus value and the opportunity set for value stocks in that new regime?
That's a really important question to consider right now, because what we have found over this last decade, we've seen a lot more central bank, I don't want to call it interference, but we've seen a lot more action by the central banks across the globe trying to prop up the economies. And I think it has changed the dynamic a little bit. But if you look at where we're at right now in terms of central bank stimulus, let's take the U.S. as an example. And if you think about what the central bank is doing in terms of pumping money into the system, but also if you take into account the fiscal stimulus that we're looking to incorporate as well, or looking to pass into legislation here, what you'll find is there's about $9.5 trillion that's going to come into the economy. Let's think about the GFC, in which that was $800 billion. So we're talking 12 times the amount of stimulus that we had back in 2008 is coming now into 2020. I think it's going to be a little naive to think that that is not going to create some level of inflation or some level of action or some greater level of economic growth that we should expect. And if you think about the last decade, we haven't really been above trend growth for that decade. And I think what this will do is it will, let's call it a bit of a catalyst to get that growth going. And if we get above trend growth again, that's going to work really well for value stocks.
But couldn't you argue that with low inflation and low interest rates, which are basically caused by the continual flood of capital into the system, that'll serve as a headwind to value stocks and their future success?
Yeah, and that's the point that the growth managers are going to be making, and why not? Growth stocks are long duration stocks. So if you end up having low interest rates, low inflation, the growth rates that you're looking 25, 30 times, that doesn't look very hard to achieve at this point in time. It may even in some cases look rather attractive. However, I don't think that can actually be sustainable. As I mentioned, all this stimulus coming into the system, and if you start to get above trend growth, and start to get inflation, especially if it gets near the target, the Fed targets and other central banks' targets, what you're going to find is they're going to want to start moving rates up. They're going to want to start doing something different, because if you look at the firepower that these economies have right now to fix any crisis as it comes along, it's almost like they've spent most of their bullets at this point, and I think they would like to reload at some point. So think about in 2016 and 17, where we started to see that path, where here in the US you saw tax cuts, you saw that which stimulated the economy. You saw interest rates were starting to move back up again, all in hopes that they would have something to be able to combat the next crisis. So I think once we get that economic growth to start to go up and be higher, I think you're going to find these central banks wanting to raise rates and getting some firepower put back into their coffers again.
So in that scenario, value becomes attractive again. but it's not just value in general, but what is it about Barrow Hanley's style of value that would come back into favor?
Exactly, and as I mentioned earlier, Barrow Hanley, it's just not about factors for us, okay? We're thinking it's more than just investing in a price-to-book stock, a low price-to-book stock, or a low PE stock. You actually have to have some level of judgment, some level of experience to help you navigate through that. So first and foremost, what I'm going to say, we're Barrow Hanley of 40 years of investment experience. It's a lot of investment experience sitting around a table, talking about stocks, talking about company management. It gives you really good judgment and the ability to navigate markets that you've actually seen similarities with before. I think that's a key difference, is to be able to have that pedigree of value investing for 40 plus years. We think we've done it really well for the last 40 years, and we think we're well positioned to do it for the next 40 years. But also importantly, if you were to look at our global value portfolio and look at how we're positioned currently for this market environment, what you'll notice on those factors that I mentioned previously that work really well coming into a value environment, we're really well exposed to those. We have one of the lowest price to books that we've had. Price to earnings as well, EV to EBITDA, EV to sales, and also an above market yield. So we think we're really well positioned for this next value cycle. We did that in 2016-17, in which we were positioned similarly, came off the bottom really strong, and our portfolios performed really strongly.
From the sounds of what you just described, it appears to me that the Barrow Hanley Global Value Strategy has multiple ways to win. Is that a fair statement?
Yes, and I think it's something you have to have in a portfolio. You can't win just in a singular fashion. So a Barrow Hanley portfolio, yes, we're going to be exposed to factors, such as the value factors, price to book, but importantly, I mentioned the 40-year history that we actually have. And I think it's important to think about our portfolio management team, our research team, having that depth of experience where when we get in front of company managements and when we're doing an analysis of, say, the financial statements or the competitive landscape, we've seen this before. We know how to analyze it, and we know how to make important judgments to position ourselves well to outperform going forward.
So James, one final question I have for you, which would be, why value, why now, and if now, why Barrow Hanley Global Value?
Well, you know, we could do an entire podcast on just that question alone, but let me see if I can be succinct about that. If you think about why value now, we're 10, 11, 12 years into this bull market that's favored growth. There's not a lot of investors still out there who've seen what a value rally actually looks like. And if we think about the period from 2000 to 2007, where we had a very strong value rally, what you saw is let's take the median value manager in the global space as we look at it, outperformed the median growth manager by over 300 basis points. So a very large delta. If we look at this most recent run where growth beat value, that delta of growth beating value, the median manager, maybe 170, 180 basis points. And interestingly enough, now, as of this last quarter, the median growth manager, global growth manager, has underperformed the MSCI World Growth Index. So it's even getting harder for growth managers to even outperform, whereas a couple quarters ago, they were a little bit of ahead of the growth index. So why value? Because you can get outsized returns to value, okay? Over the index, over your peers, you get really strong returns. Why Barrow Hanley? Again, I'll harken back to our 40 plus years of experience. We've been doing this for a very long time. We're not going to change our stripes. We didn't do it in '99 when everybody thought we were just looking like idiots, and we held to our discipline, but that set up a great 2000 to 2007 for us. So we're not going to change our stripes. We continue to be that value manager that we've always been. And honestly, we're exposed well to it, to these, not only these factors, but also just how value actually works. And our experienced professionals are actually going to navigate this market quite well, given the level of experience that they have, the amount of judgment they bring to the table. Again, I think you really want to be able to be tied to a strong pedigree of value investors.
James, I'd like to thank you for the time. Thank you for the analogies. And I hope all of you out there watching this come away with a better appreciation for value and why Barrow Hanley Global Value now. Thank you.